You ever seen a massive real estate project and wondered, how could you be a part of it? What if I told you that you don't have to be a billionaire to invest in these lucrative opportunities? Well, welcome to the world of real estate syndication, a gateway for investors like you and me to pool our resources and invest in major real estate opportunities. Before we get into today's video, if you're new here, I'm Dr. Jeff Anzalone on a mission to get you to the point where work is optional. Do me a favor, download our free passive income guide I put directly for you with the link below this video. Let's start off by basically answering the question, what is a real estate syndication? Real estate syndication is a strategy where multiple people, multiple investors like you and I, we combine our resources to invest in properties that would be basically too costly for one of us to handle by ourselves. This method not only opens the door to large-scale real estate projects, but it also spreads out our risk amongst all the investors involved. Next question let's answer. Who are the key players in these real estate syndications? Well, you have two main groups. Number one, you've got the sponsor, which is also called the general partner. All right. These are people that find the investment opportunity. They manage on a daily basis. They oversee operations. You can kind of think of them as like the pilots on a plane. You know, if you're going on a trip, you got the pilots on the plane, and their goal is to get us, the passive investors, which is actually called the LP or limited partners, we'll get into in just a minute. Their goal is to get the LPs, all of us, the investors, to our destination. The destination is to eventually take the property, get the returns, and then sell it down the road for a big exit, for a big return. And speaking of LPs or limited partner, again, these are people like you and I who supply the capital required to fund the project. In exchange for our investment, we receive a portion of the profits, which is proportional to the amount that we've invested. All right. So now let's kind of break this down, how real estate syndications work. All right. So the first thing is, and this is going to be mainly the general partners who are going to be doing all this. They're going to ID the property, all right? And when they identify the property or properties, then they're going to perform what's called due diligence. So they identify, let's say, a promising real estate opportunity. Let's say it's an RV park somewhere, maybe in Florida. They identify this RV park, and then they start looking to see, what it's about. They tend to looking at the numbers. They're putting things together to see if this deal even works. So they're looking at the property's potential for high returns, and they're doing market analysis, property inspections, financial assessments, all of that kind of stuff. All right. Now let's say everything passes the test and then they want to do this. Well, so now they're going to the limited partners, right? And what are they going to do? They're going to gather capital, right? So under this leadership of the syndicator, they get the investors to come in, they pool their financial resources. And this phase includes securing commitment. So when people raise their hand, they do a soft commitment. Hey, yeah, I'm interested. Let me go through myself and look at what this RV park entails. Let me look at numbers, maybe get somebody to look at the underwriting, that sort of thing, and secure the commitment. And then if that passes your test, as a limited partner, now you can wire your investment in, or you could do an ACH transfer to basically move forward with the investment. So there'll be a portion of the capital. So for this project, there's a portion of the capital coming from the limited partners. And there's also going to be a portion of this coming from debt. So this could be bank debt or other debt to get that leverage. Okay. And what they'll do is a lot of times they'll negotiate favorable loan terms that again, that's going to complement the investor's equity to finance the acquisition fully. Because rates are so high right now, what we've been able to do in our group with purchasing RV parks, we've been able to negotiate seller financing, which is great for the seller because now we're going to be paying them. Think about it. If you own, let's say you own a property, say you own we just closed on a property, an RV park in Montana. Think about if you own that park and you're just basically just walking away and it's kind of like, well, I don't really have any money coming in. Well, we've negotiated a 5-year, 6% rate with them, seller financing. So now they walk away and the seller is getting paid by us every month for the next 5 years. So it's nice for them because they still have money coming in while they're trying to figure out the next phase of their life, which at this point they don't know. And so it's a great way that we could help them with that, but also with us it's great because we don't have to pay what the high interest rates are right now, which are 8.5%. Okay. So once everything gets done, then you have to start, the general partners have to start with management because you got to take care of your tenants, right? So the property acquisition phase is so when the equity and the debt financing's in place. Then they come in, they form an LLC, and then the LLC will typically hold the property. Remember, the pilots on the plane, the general partners are the pilots on the plane. They do all the active management. They take the responsibility of managing the property, overseeing if there's any renovations, managing the tenants, handling the leases, maintaining the property to basically, in every which way they can, enhance its value, because we want to maximize the revenue streams. Because again, they're paying the preferred return typically on a quarterly basis to us investors. So for instance, let's say you put in $100,000 and it's an 8% preferred return, 8% of $100,000, you're going to be getting $8,000 a year, or typically it's paid out quarterly. This comes out to being $2,000 per quarter. And I'm not going to get into all the depreciation and taxes, but typically you'll get enough depreciation from your property to offset this passive income. This is just literally tax deferred. It could be tax deferred forever, depending on your strategy. Income. Think about what your income coming in now from your W-2, your day-to-day job. It's not tax-free, is it? This is why I love these things. All right. So again, we just went over this phase, and this is the distribution of profits. So as people are paying their rent, there's multiple different streams that we get from our RV parks with propane, laundry facilities, ice, those types of things, sometimes golf cart rentals, any type of revenue coming in after the expenses, then we can pay out this preferred return, okay? This distribution of profits, this ongoing revenue, all right? And again, these are, sometimes you'll be in a project where they pay out monthly, but the majority of the time it's quarterly. And then there's actually sometimes, if applicable, the property may go through what's called a refinance, okay? And let's say somebody got in at like an 8.5% rate. Well, if the rate's dropping up, you could refinance that just like you can your house. This is going to improve the financial terms and release equity, which can also result in additional distributions to the limited partner. Now, the great thing that we're all looking for is that big exit, right? Most of the time, these syndications, typically are a 5 to 7 year hold. All right. So at the end of this period, let's just say for this, it's 7 years. At the end of this period, they're projecting that they're going to sell the property. So let's say next year we're coming on year 7. We're starting to get everything ready. Kind of like if you're going to be selling your house next year, there's things you're going to start doing to get it ready to sell. No different than a property. And then whenever it's sold, the sales proceeds are used to pay off any remaining debt. Then that's when this distribution, so the exit, the leftover profit is going to go to the LPs, right? Before it goes to the general partners. So the limited partners are paid first, okay? Limited partners paid first, and then the syndicator or the general partners are paid. And each of these structures are different. For the most part, the majority of them are the same, but there could be some little nuances. But when you're going through your due diligence, everything will be spelled out in something called a PPM, a private placement memorandum. This is like 100 plus of, you can get it printed out, but typically we'll just email it to you as a PDF. It's basically the legal document of the real estate syndication. Everything is outlined, including the distribution structure at the exit. All right. It's already predefined in the syndication agreement. Again, it's called the private placement memorandum. Now, one thing that's really important that whenever you're doing due diligence on a syndicator to invest with is you want to make sure you check their communication. Are they communicating with their investors both before, during, and after all of this takes place? What you could do is you could simply, let's say you're interested in a project of syndicator XYZ, you can ask to speak with some of their investors, or if you go out and network, which I recommend that you do, you go ask them, have they invested with them? What's their communication like? Are they quarterly updates? Are there monthly updates? If you have questions during the process, how likely are they to get back with you? Do they get back the same day? Is it a week? Is it a month? I mean, I've dealt with people with, for my aspect, I've dealt with all kinds of syndicators, both as a limited partner and a co-general partner. And kind of like my dad said, son, if you want something done right, you do it yourself. That's why I've gone out and we formed the Blue Metric Group, which we're buying RV parks, just because it could be done better. And I knew the things from my past experience, both the things that were done good, but also things that could be done better as well. And that's the main reason why we started the Blue Measure Group. But anyway, regarding the communication, the investor updates, you want to make sure that these are happening throughout the entire investment life cycle, okay, that they're updating you. What are they going to cover? Well, they're going to cover the financial health of the investment, any operational issues, if they're doing any type of maintenance work, any type of rehab, market conditions that may be affecting the property. We have an RV park here in my hometown. Well, last month we just had literally 8 to 9 inches of rain in 24 hours. So we're updating the tenants, plus we're updating the owners, the other general partners, about some of the flooding that's affecting the area. If there's storms coming in, whatever, this needs to be communicated. And any strategies that are going to be employed along the way to maximize return. All right. So again, real estate syndications, they provide a great and unique opportunity for you to get involved in these major real estate projects. You're able to diversify your portfolio and get some pretty considerable returns compared to the stock market. Now, if the idea of tapping into the real estate market interests you, but you're really kind of unsure to begin, then these types of investment, these syndications, might be the perfect entry point. Now, if you found this video useful, do me a favor, give it a thumbs up, subscribe to this channel, and if you want to learn more about how to find the best syndication deals, then you can simply go here and check out this video.